There are only two things certain in life: death and paying taxes. I mean, think about it. Do you know anyone immortal or anyone who has never paid any taxes? And not to be Captain Obvious, but you're literally watching a video about taxes, so I assume you must pay your fair share. But anyway, before we carry on, please know that this content is not tax or financial advice, but just educational. For your personal tax situation, verify with your tax accountant or advisor. Now, let's get to the topic. There are two main types of taxes in crypto. One is called capital gain tax, and the other is called income gain tax. Now, depending on where you live, both taxes will be implemented differently for you than what's presented in this video. But the concepts usually remain similar. When it comes to capital gains taxes in crypto, they are usually taxes based on your profits, while income gains taxes are usually based on what's considered an income, a similar process than the stock market in general. In most jurisdictions, profits made selling, trading, and disposing of cryptocurrencies are considered capital gains, while receiving a wage, staking, mining, and interest from lending are typical income gained activities. Both taxes are subject to an inclusion rate decided by your government. Let's give an example with country A and country B. Country A has a 100% inclusion rate, and country B has one of 50%. Let's now say two individuals invested $10,000 worth of Bitcoin and sold their respective investments once they reached $20,000, giving them $10,000 of profit each. And now let's assume both individuals have a 30% tax rate. The individual in country A would have to pay 30% on 100% of the profit he made, meaning $3,000 in total, while the individual from country B would have to pay 30% on 50% of the profit, meaning $1,500. This, my friend, is the impact of the inclusion rate. The next thing to know is whether you're operating in a flat tax system or a dual-tier tax system. In a flat tax system, no matter how long you hold an investment before selling it at a profit, you'll normally pay the same amount of taxes. So whether you made a $1,000 profit on an investment after 1 week or after 10 years of holding it, your tax liability wouldn't change. Unlike a dual-tier system, which typically has short and long-term capital gains, where profits within 1 year are not taxed at the same rate as those beyond. A good example of a dual-tier system is the one the United States uses. Now let's give some examples of when capital gain taxes are applied in crypto. Let's say you made a $10,000 investment in Bitcoin 2 years ago that is worth $20,000 today, and now you want to make a move with it. You have 4 options. 1, you can sell it to get dollars. 2, swap it to get another coin like Ethereum. 3, buy something like a car, or finally give it as a gift to a friend. If you picked 4, I want you as my best friend. Now let's say your inclusion rate is 100% with 30% taxes to pay. In this scenario, you'd have for each situation to pay 30% of the $10,000 of profit you made from the original investment, meaning $3,000. Do you understand the general idea here? No matter the action, if it is a capital gain event, it is pretty much taxed the same way. Now let's dive back in the income gain part. You may or may not know that the crypto market has vast ways of giving dividends to its investors and even workers. Among the many ways, some of the most popular are receiving as a wage or an income through staking, mining, or lending money. Usually, you are taxed at the fiat currency equivalent at the time you received your crypto payment. Let's say you receive 1 Ethereum worth $3,000 as a payment in 2025, but at your tax season in 2026, it is worth $20,000. You'll generally have to pay income tax on the $3,000 price instead. Now, let's say your income for the year puts you in a bracket where you have to pay 40% taxes in your country, and that you made $5,000 through staking the same year. You'll probably find yourself having to pay around 40% of that $5,000. The same idea goes for all other income gain tax trades. There are other ways crypto can be taxed, but these are the most common encounters that most crypto investors will have to deal with. Now you may ask, how do I actually do my taxes? Well, it depends on multiple factors such as which exchanges you use to trade and if they give you proper tax papers. In most cases, the answer is no, and often, even if they do, they are not complete, especially if you moved your coins from one exchange to another. In this scenario, especially if you're very active, you'll often have to complete with a crypto tax software and your accountant. For the crypto tax software, if you don't know where to start, we suggest you to try or take a look at CoinLedger, Coinly, or TurboTax for a start. Now, this is not a promotion, and there are other software that may be more adapted to you, but these 3 are some of the popular ones that tend to work well for most people. So, what do you think? Did this video help you understand crypto taxes a little bit better, or is it still confusing to you? Feel free to comment your thoughts below, and don't forget to like and subscribe if you liked it or want to see more content like this. Have a nice day.